Debt has a bad reputation. Most people associate it with stress, pressure, and losing control. Credit cards feel like traps, loans feel like obligations, and every monthly payment is a reminder that money is already spoken for before you even earn it. But that perspective changes completely when you look at how wealthy individuals use debt. In their world, borrowing money isn't a burden, it's a strategy. Some of the richest people on the planet fund their lifestyles almost entirely through borrowed money. And somehow, instead of falling behind, they become more secure, more powerful, and significantly wealthier over time. So what's really going on here? Why does the same concept, which is debt, create two completely different outcomes depending on who uses it? Welcome to A Kid's Dream, where we break down how money actually works so you can start seeing the game from a different perspective. To understand this, we need to start with how debt actually works in real life, in a practical way. For most people, debt is tied to things that either lose value or don't generate any income. A car gets cheaper every year, a house ties up your cash, and credit card balances quietly grow in the background. The real issue, though, isn't just what people borrow for, it's how they pay it back. Most individuals service their debt using after-tax income. You earn money, pay income tax, and then use what's left to cover interest and principal. That means you're losing money in two directions at the same time, first to taxes, then to the bank. Month after month, part of your income disappears before you even get the chance to use it freely. And over time, that pressure builds. From the outside, it looks like debt itself is the problem, but that's not entirely true. Debt becomes dangerous when it doesn't give you any leverage. For the average person, debt is often built on a fragile foundation. Income can fluctuate, savings are limited, and there aren't many assets backing up the loan. If something goes wrong, for example, losing your job, unexpected expenses, or even just a few missed payments, the entire structure starts to break down. In that situation, the bank holds the power. Until the loan is fully paid off, the asset isn't really yours. You're essentially paying for the right to keep it. This is also why consumer debt tends to come with higher interest rates and stricter terms. From the bank's perspective, the risk is higher, so the cost of borrowing increases to match that risk. Everything depends on your ability to keep earning and keep paying. Now let's flip the perspective. Wealthy individuals also borrow money, but they do it from a completely different position. Instead of borrowing because they need money, they borrow because they already have valuable assets. That one shift changes everything. When a bank evaluates a typical borrower, it looks at income. But when it evaluates a wealthy borrower, it looks at the balance sheet, which is what they own, how stable it is, and how likely it is to grow over time. If someone owns a $20 million asset and borrows $5 million against it, the bank isn't worried. Even in a worst-case scenario, the loan is still covered. Because of that, interest rates drop, terms become more flexible, and access to capital becomes easier. At that point, borrowing isn't about survival, it is about liquidity. It's a way to access cash without giving up ownership of assets that continue to grow. And this is where things start to sound almost counterintuitive. Many wealthy individuals don't rush to pay off their loans in the traditional sense. Instead, they keep their assets invested and allow those assets to appreciate over time, while using borrowed money to fund their lifestyle or new opportunities. According to the Global Wealth Report by Credit Suisse 2023, high-net-worth individuals tend to prioritize preserving and growing their assets, using financial tools like leverage to maintain liquidity rather than liquidating investments. This approach allows their wealth to keep compounding in the background. At the same time, there's another layer to this strategy, which is tax efficiency. Research from the Economics of Capital Gains and Taxes by OECD 2022 shows that capital gains are often taxed differently than earned income in many countries. By holding on to assets instead of selling them, investors can delay taxation while still accessing cash through loans. So instead of interrupting the growth of their portfolio, they let it continue working for them. On a bigger scale, this reflects how the financial system rewards asset ownership. The World Inequality Report by World Inequality Lab 2022 highlights that individuals who own appreciating assets benefit more from financial tools that amplify growth, including leverage. In other words, debt itself isn't the deciding factor, but the structure behind it is. Used one way, it creates pressure and limits your options. Used another way, it expands your flexibility and accelerates wealth building. At A Kid's Dream, we focus on breaking down ideas like this in a way that actually makes sense in real life. The goal isn't just to explain how money works, it's to help you see the patterns behind it, understand the rules of the game, and for you to apply it as appropriate to your own circumstances. Once you start looking at things from this perspective, you may know how to structure your financial plan more effectively. Alright, now that we've set the foundation, let's go deeper into how the wealthy actually structure their lives around borrowed money. It all starts long before any loan is taken. The real work happens in building assets that banks trust more than individuals. The types of assets held by wealthy individuals tend to share a few important characteristics. They grow in value over time, remain relatively stable, are easy to evaluate, and can be converted into cash when needed. Think about publicly traded stocks, income-generating real estate, or private businesses with consistent cash flow. From a lender's perspective, these are far more reliable than a salary. A job can disappear overnight, while a diversified portfolio or prime real estate rarely collapses to zero. According to Global Financial Stability Report by International Monetary Fund 2023, diversified financial assets and income-producing properties tend to show stronger resilience during economic downturns compared to labor income, which is more sensitive to shocks. This is why, at the highest level, lending decisions shift away from income and toward asset quality. The next step is borrowing conservatively relative to what you own. This is where the concept of loan-to-value becomes critical. The lower the percentage you borrow compared to your assets, the safer you appear to the bank. If someone owns $10 million in assets, asking for $1 to $3 million is a very different conversation compared to asking for $10 million. When assets reach $50 million or more, borrowing $5 to $10 million becomes well within a comfortable range for lenders. At low loan-to-value ratios, risk drops significantly. As a result, interest rates improve, terms become more flexible, and access to capital becomes much easier. From the bank's perspective, the borrower could repay at any time by liquidating a small portion of their portfolio. That safety margin is what unlocks better conditions. Now comes the structural difference that changes everything. Most people take income-backed loans. These are tied directly to their paycheck, which means they are required to repay both principal and interest on a fixed schedule. Over time, the debt is fully paid off, and there's little room for flexibility. Wealthy individuals, on the other hand, primarily use asset-backed loans. Instead of relying on income, these loans are secured against assets they already own. Because of that, the structure changes. In many cases, borrowers are only required to pay the interest, while the principal remains untouched for years. This creates a completely different dynamic. The goal is no longer to eliminate the loan as quickly as possible. The goal is to maintain access to liquidity while keeping assets invested and growing. Let's walk through a simplified example to make this clearer. Imagine someone owns a portfolio consisting of real estate, stocks, and land worth a total of $50 million. They approach a private bank and request a loan backed by these assets, with the intention of using that liquidity for living expenses or new opportunities. The bank agrees to lend $10 million at an interest rate of 3% over a 10-year period. That's a 20% loan-to-value ratio, which is considered very safe in private banking. The funds are transferred into the borrower's account. Since this is borrowed money rather than earned income, it is generally treated differently from a tax perspective in many jurisdictions. Based on tax policy reform and economic growth from OECD 2020, many tax systems distinguish between earned income and financial transactions, such as loans, which can influence how individuals structure their cash flow strategies. The only required payment in this case is the annual interest, which is $300,000 per year. At this point, the borrower has full control over how that $10 million is used. They might choose to spread it out over time, treating it as a steady stream of spending power across the decade. 10 years later, they've paid $3 million in interest, while the original $10 million principal remains unchanged. So what happens next? There are a few options, though two are especially common. The first option is refinancing. A new loan is taken to replace the original one, and the borrower continues paying interest under updated terms. This allows them to maintain liquidity without needing to sell assets. Selling assets can come with significant consequences. To generate $10 million after taxes, a much larger portion of the portfolio may need to be liquidated, depending on tax rates and capital gains. That also means giving up future growth on those assets. From a long-term perspective, maintaining ownership often becomes more valuable than eliminating the loan. The second option builds on the same idea, but takes it a step further. Option 2. Expansion. If the asset portfolio has grown over time, the borrowing capacity increases as well. Let's say that $50 million portfolio has now doubled to $100 million. At the same 20% loan-to-value ratio, the borrower could now access $20 million instead of $10 million. The previous loan is paid off, additional liquidity is unlocked, and the cycle continues. According to Global Wealth Report by Credit Suisse 2023, long-term wealth accumulation is often driven by the ability to keep capital invested while using financial instruments to access liquidity, allowing compounding to continue uninterrupted. This is how the system reinforces itself over time. Assets grow, borrowing capacity expands, and liquidity remains available without disrupting the underlying portfolio. This is the path most wealthy borrowers tend to follow. At this point, a natural question comes up. What happens if the assets stop growing? The answer lies in the type of assets involved. These loans are typically backed by productive and diversified holdings, maybe real estate, operating businesses, land, and broad market investments. These are fundamentally different from speculative or highly volatile items. Over long periods of time, these categories of assets have shown a consistent upward trend, even though short-term fluctuations are always part of the journey. According to Global Investment Returns Yearbook by Credit Suisse 2023, diversified portfolios across equities and real estate have historically delivered positive real returns over extended time horizons, despite cycles of volatility. That long-term growth, combined with conservative borrowing, creates a strong margin of safety. Because loans are structured at low loan-to-value ratios, even significant market declines rarely threaten the stability of the loan. The buffer is built in from the beginning. This is one of the reasons asset-backed loan failures at an individual level are relatively uncommon. When disruptions do occur, they are usually tied to broader financial crises that impact entire systems rather than isolated borrowers. Banks actively monitor collateral values and adjust conditions when necessary, often well before any serious risk develops. The entire system is designed to manage risk dynamically rather than react at the last moment. And that's how the strategy holds together over time. Now we arrive at the final stage of the process, the one that most people rarely think about, which is inheritance. At some point, life comes to an end. And when that happens, both assets and liabilities are passed on. Let's start with the assets. As long as they haven't been sold during the owner's lifetime, their gains remain unrealized. In many tax systems, something interesting happens at the moment of inheritance. The value of these assets is adjusted to reflect their current market price. This means that if an asset was originally purchased for $1 million and is worth $10 million at the time of transfer, the new cost basis becomes $10 million. According to Capital Gains Taxation and Inheritance by OECD 2021, several tax frameworks apply a step-up in cost basis at inheritance, effectively resetting the taxable gain for the next generation. In practical terms, this has a significant impact. If those assets had been sold before death, taxes would typically apply to the full gain. But when they are passed down and sold afterward, the taxable gain may be minimal or even zero, depending on the jurisdiction. The difference between selling during life and transferring through inheritance can reshape the long-term outcome for an entire family. Now let's look at the loans. Any outstanding debt still exists, but the way it's handled changes in context. The next generation can settle those obligations by selling a portion of the inherited assets. Because of the adjusted valuation, this can often be done with far less tax impact than if the original owner had sold the assets earlier. So a loan taken decades ago can be resolved using today's asset values, often in a more efficient way. After that, the same structure can continue. Assets remain invested, borrowing provides liquidity, and the cycle extends across generations. According to World Inequality Report by World Inequality Lab 2022, intergenerational wealth transfer plays a significant role in maintaining and expanding wealth over time, especially when supported by financial structures that preserve capital. This is how wealth compounds across decades, sometimes even centuries. The broader system of asset-backed borrowing has existed in different forms for a very long time, evolving alongside financial markets and legal frameworks. As long as assets continue to generate value, ownership remains meaningful, and capital seeks stability. This approach will continue to be part of how wealth is managed at the highest levels. That's all for today. We'll see you in the next one. Take care and wish you a good day.